All right, today we're tackling a massive question. In a world where all the old economic rules seem to be shifting, where on earth can capital actually find safety? The whole financial landscape is changing right under our feet, and we're here to help you make sense of it. But let's kick things off with a single number that really sets the stage for everything we're about to talk about.
That number is negative 7%. Right now, that's the fiscal deficit of the United States, give or take, measured as a percentage of its entire economy. So, to put that in simple terms, for every dollar the U.S. economy makes, the government is spending about 7 cents more than it's taking in. That is a massive, massive hole in the national budget, and it's the real starting point for this whole story about debt, risk, and the future of money.
So, here's our game plan. First, we're going to look at the classic pattern of how a nation gets into financial trouble. Then, we'll dive into this triple deficit problem. After that, we'll see how the rest of the world is reacting, we'll map out some potential safe havens, look at a pro-strategy called the carry trade, and then finally, we'll bring it all back to what this means for you and your own portfolio.
Okay, so first up, the sovereign bankruptcy pattern. The best way to get your head around this is to just think of a country's finances like a regular household budget. When spending gets out of control and the bills start piling up, a very predictable pattern starts to play out. Doesn't matter if you're a family or a global superpower.
It always begins with insolvency. It's a simple concept, really. You're spending more money than you're bringing in. For a country, this means government spending on everything. Social security, defense, healthcare is way higher than what it's collecting in taxes. And this isn't some temporary blip. The United States, for example, has run a budget deficit every single year since 2001. Think about that. Over 2 decades of consistent overspending.
So this slide here lays out the inevitable path. It starts with that insolvency, that consistent deficit spending. To cover the gap, a country first drains its savings account. When that starts to run dry, it moves on to step 2, borrowing. It issues government bonds, basically IOUs, to investors at home and abroad. But you can't do that forever. Eventually, you hit a crisis point where the savings are gone, the credit cards are maxed out, and the lenders who used to be eager to buy your debt, well, they start to get nervous. And that is the danger zone.
Now, let's see how this problem can get so much worse. For some of the biggest economies in the world, it's not just one deficit that's the problem. We're looking at a compounding crisis, something we call the triple deficit danger zone, where 3 separate financial pressures are all hitting at the exact same time.
So what are these 3 deficits? First, you've got the fiscal deficit we've been talking about, the government spending more than it earns. Simple enough. Second is the current account deficit. This means the country as a whole is buying more stuff from the world than it's selling to the world. And third, you have the energy or commodity deficit. This means the nation depends on other countries for the critical resources it needs, like oil and gas. You see, each one of these is a vulnerability on its own. But when you put them all together, that's a potent recipe for instability.
This slide really gets to the heart of our entire explainer today. On the left, you've got a triple deficit nation. It has government debt, it imports more than it exports, and it has to buy its energy from someone else. But on the right, you have the exact opposite, a triple surplus nation. Its budget is balanced, it sells more to the world than it buys, and it's a net exporter of the very energy that everybody else needs. So in a volatile world, which of these 2 profiles sounds more resilient to you?
And hey, don't just take my word for it. This isn't some abstract academic theory. This is a direct quote from Standard & Poor's when they actually downgraded the United States' long-term credit rating. And the reasons they gave? They weren't vague. They pointed directly to political risks and a rising debt burden. The market is watching these deficits, and it is definitely getting nervous.
Okay, so how is the rest of the world reacting to all these vulnerabilities? Well, a growing number of countries are making a quiet but very deliberate bet against the US dollar's long-term dominance. This is what people are calling the de-dollarization trend, and it seems to be picking up speed.
And at the forefront of this whole movement, you've got the BRICS nations. That's Brazil, Russia, India, China, and South Africa. What's crazy is that combined, their economies are now roughly the same size as America's. And what's really key here is that this group includes major commodity exporters and geopolitical rivals who have a really strong incentive to build a global trade system that doesn't depend on their competitors' currency.
And this is absolutely moving from talk to action. In 2022, Russia started settling huge oil sales with India in currencies other than the US dollar. Then in 2023, China and Brazil made a deal to settle trade between themselves using their own currencies, completely bypassing the dollar. And the whole BRICS alliance is even talking about a new common currency, maybe even one backed by a hard asset like gold, to really challenge the dollar. This is a coordinated push to build an alternative system. This chart shows you the tangible results of all this. Back in the early 2000s, the US dollar made up about 70% of all foreign reserves held by central banks around the world. It was the undisputed savings account for the entire globe. Today, that number has dropped to around 59%. Now, it's not a crash, but it is a steady, undeniable decline in the dollar's role as the world's #1 reserve currency.
Okay, so we've outlined the risks in these triple deficit economies, and we've talked about the de-dollarization trend. And all of this leads us to the most important question of all. Where does capital go for shelter? If the old safe haven is starting to look a little shaky, what does a new one even look like?
The alternative is pretty much the mirror image of a triple deficit country. We're seeing capital start to flow toward nations that are insulated from these problems. Countries that are net exporters of commodities that are in high demand, that run a fiscal surplus, and that have strong, healthy balance sheets.
So if you were going to build a checklist for a potential safe haven, what would be on it? Well, first, little to no government debt. That gives them a ton of flexibility in a crisis. Second, a surplus of stuff the world desperately needs. We're talking energy, food, critical materials. Third, a positive current account, which means they're a net exporter bringing foreign currency in. And finally, all of this has to be built on a foundation of political stability.
Now, let's peel back another layer and look at a specific strategy that the pros use to act on these massive global shifts. It's called the currency carry trade. And I know, it sounds complex, but the logic behind it is actually pretty straightforward.
At its core, a carry trade is all about taking advantage of the differences in interest rates between countries. The idea is you borrow money in a currency where interest rates are super low, and then you take that same money and invest it in a currency where interest rates are high. Your whole goal is to profit from the difference, or the spread, between the high interest you're earning and the low interest you're paying.
Let's just walk through a classic example. An investor might borrow Japanese yen, where interest rates have been practically zero for years. They then convert that yen into a currency like the Brazilian real, where interest rates are much higher. Then, they use those reals to buy high-yield Brazilian government bonds. If everything goes according to plan, the high interest they get from the Brazilian bonds more than covers the tiny bit of interest they owe on the yen they borrowed. That difference? That's their profit. So, we've covered the huge global macro picture, we've identified what a safe haven might look like, and we've even broken down a professional trading strategy. But now, let's bring this all home, because the final, and maybe the most personal piece of this puzzle, is confronting our own investment biases.
And here it is, the brutal truth. Home country bias, that natural tendency we all have to invest heavily in our own country's market because it just feels safe and familiar, is at an all-time high. For so many investors, especially in the US, this means their entire financial future is almost completely tied to the performance of a single economy and a single currency. It's a massive and often totally unintentional concentration of risk.
Take a look at this chart. Does it seem familiar? Maybe. Maybe it looks a little bit like your own portfolio. It's overwhelmingly concentrated in US stocks and US bonds, with maybe just a tiny little sliver dedicated to international markets. This portfolio is making a huge implicit bet that the economic conditions that drove amazing returns for the last decade are just going to continue forever. And given everything we've just talked about, is that a bet you're still comfortable making?
And that is the final question we want to leave you with. In a world of triple deficits, de-dollarization, and shifting economic power, the strategies that worked so well in the past might not be the ones that protect you in the future. Your portfolio is perfectly designed for the world of yesterday. The question is it truly ready for the world of tomorrow?